We're talking energy stocks today with our senior equity analyst, Mark Taylor. Thanks for your time today.
You're welcome.
Now, we've seen a big drop-off in oil prices recently. They're at 18-year lows. There's a glut of oil because coronavirus has halted activity, and energy is the lifeblood of the economy. Should we assume that energy firms will bounce back?
Absolutely. This is a crisis it's going to exist for a short period, but it's not going to go on indefinitely. And energy is at the foundation of all economies. You can't survive without reliable and consistent energy supply.
Morningstar currently rates 4 oil and gas companies as 5 stars, so undervalued. Which of these do you prefer?
In that kind of a question, there's always a purely value answer to the question, and then there's also a quality answer to the question, and you try to strike a balance. The best value on offer at the moment is probably in Santos and Woodside, which makes it easier because they are at the same time the 2 best quality names from our perspective. Woodside has a pristine balance sheet, very low debt levels, and it's also a low-cost producer. So it is very well positioned to weather any short-term route in oil price, but it's also an attractive longer-term buy because it is a low-cost, high-quality producer. Santos sits similarly into that sort of boat as well, but its balance sheet is not quite as attractive as Woodside's. It is more leverage than Woodside, although it definitely doesn't have excess leverage, and it is a comparatively low-cost producer as well. So those 2 would be the companies that we'd be recommending most overall, or across a broad range of considerations.
And Mark, are Australian oil and gas companies positioned differently to some of the offshore oil majors?
Well, yes, in multiple ways. It's always best to have low costs as your ultimate line of defence, and these companies are clearly very low cost. But the other aspect that's interesting is that the Australian gas companies are very gas exposed as opposed to liquids exposed. That means they're potentially less reliant on transport and airline derived demand for fuels. Gas sold into Asia and domestically is more important for industrial purposes and domestic heating and cooking and that sort of thing. So you'd expect demand, or volumes at least, to weather a coronavirus storm better than liquids, even though the price can obviously be very aligned with the Brent price. So you're not so much getting price protection as volume protection through the contracts and the nature of the market that you're serving. A company like Santos, however, with its considerable domestic gas business, does potentially get some more price protection because domestic gas prices are less immediately exposed to a weakened crude price.
Mark, how important is the decision by Saudi Arabia and Russia to finally agree to reduce their oil production to the price of oil that we've seen?
Well, in an immediate sense, it's very important because you've got this situation with an excess of supply into a demand scenario that's been completely ratted out by coronavirus, causing lockdowns, people to stay at home so they're not driving as much. You're not traveling, so airlines grounded. That's about 1/6 of oil's consumption there, gone away. And then on top of that, you've had the Saudis and the Russians, a breakdown in agreement to curtail supply, so excess of supply into the market as well. So in the short term, it's very important that they've come to this agreement. I don't expect that it'll result in some magical rebound in oil price back to where it was, because the coronavirus effect is going to persist for some time yet. But eventually, you should see a recovery in oil price to some sort of semblance of a sensible level, which we think is about $60 a barrel Brent.
Because it's currently it's around $30 a barrel, isn't it?
Yeah, that's right. At $30 a barrel, a vast swathe of the global production is not even washing its face, let alone being incentivized to invest to increase production or sustain production, particularly US shale producers, for whom a $40 a barrel price is where they start to break even on average, and it's certainly well below the level that they would require to be incentivized to drill and sustain and increase production.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.